All right, guys. So gonna go over mostly general Q&A. We'll look at the Fed meeting in terms of what Jerome Powell talks about, and look at the trade for the credit spreads today. Vikas, you started with how to start hedges or how to do the hedges. You want to elaborate a little bit on that?
Yeah, so I have a couple of puts and 112s from the last 1 or 2 months.
Okay.
So how do I kind of add a hedge? Which one should I pick and where is the trade?
Okay. I'll just go over a few general things that I think about when I'm doing them. And then if you're just starting out on hedges, that's going to be a little bit tricky at first. But I think one of the main things is to come up with a plan on what amount you're either willing to use in your net liquidating value. If you're just doing a pure hedge by buying puts or buying put debit spreads. Or you could do the one-on-one type hedge trade that I do. It's not a full hedge at first, but it will become a hedge later on. So here's a few things that I'll look at for it. So if you see my Tasty trade up here, good day, up 1,400. All right, so a few things to consider. One is if you're going to do it based on being okay losing a little bit of your net lick every month or so, buying a put debit spread or buying puts is probably the best way to go. This would be a pure hedge, and if the market drops, this will benefit from it. So simple things with numbers. And I used to do this in near the beginning of the year. So I have about a $67,000 account right now. If I'm willing to use, say, 0.5% of my net lick every month just for pure hedges, you'd multiply that by 0.05, or 0.005 actually. Sorry. 0.005. I'm double clicking on my mouse there. All right, so 0.5% is 0.005. That means I could buy a hedge that costs $335. ES has a 50 multiplier, so you could divide by 50 on that. And that means the cost of the debit should be around 6 or 7 total premium. Does that make sense so far?
Yep.
Okay, so you get whatever your account size is. I think 0.5% a month should be fine. You can even go higher if you're very worried about the market. But if you're doing a lot of 112s that have those put debit spreads in as mini hedges, so to speak, already, I think up to 0.5% a month should be okay. Now, where do you actually place this? A few ways to look at it. If you look at the hedge guide, the main one I do is around 90 days out. So I'm going to go to ES around 90 days. And then I'm going to look for a hedge that costs about 6.7. If you want a hedge that's very far out of the money, you could make the width a lot longer or wider because the premiums are so low and they're very close together. So for instance, if I did like a 4,500 put, it's around 11.5 or so. I could go 6 away from this, and then I could go for around 5 premium on the bought put. I could go down around 39.50. And there you see the price is around 6 or so. So this would be a debit of about $300, but it gives a very wide protection. It gives 550 points in the width there. 550 times 50 is $27,000 profit. The problem is 4,500 is really, really far away. So you can consider going a little bit higher. If you go to say around 5,000, that's at 30. If you go 6 away, it's around 23 or so. At this point, I can only do a 100 width for about the same premium. Does that make sense?
Yep.
So now it's a bit of a balance on what you're willing to do. I'd rather have hedges that at least have somewhat of a chance of maybe profiting from it. However, it's a balance because you're going to have a lower width from it. So on my guide, I usually look around 0.08 to 0.1 or so delta on the bought put. If you go around 0.08, you could probably get a little bit more width than the 100 width that it was. So if you go around 150 width or so. sorry, it'll be 48.50, around 47.50 is a little bit less. I could go a little wider. See, I could go down to like 46 or so. And then at this point I have 150 width, could probably go around 200 width, and then get a very similar debit when you're starting it out. Now that's okay. This is all okay if you're willing to pay a little bit of a debit against your other positions. So in the safeguard trades for the 112s, they typically make around 3 to 4% a month if you look at all the numbers. So if you're
Yeah.
willing to spend about 0.5% a month on just hedges to get that additional protection, that could be a good way to go. And I was doing this quite a bit. Do you have any questions on the 111 type hedge that I've been doing?
No, on this one, how does the width, like, should we prefer a shorter width or a wider width?
I mean, ideally you have a wider width because then you have more protection and more of a max profit. Because if we get below the sold put, then we'll have the max profit at expiration. It'll just be the width times the 50 multiplier for a yes. So ideally you have a wider width. It'll give you more protection that way. If you only had a 50 or 100 width, it's not going to do too much in the end.
Okay, there's a trade-off, right?
Yeah. You could also consider just buying a put, but if you're buying a put, you'd have to go all the way to like 4,100 or so. This would be better as like a black swan type play. If I just bought a 4,100 and that's it. So a very similar debit. You don't have a sold put. So theoretically, this could make a ton of money if the ES goes to zero. I'd worry about the nuclear fallout first. But other than that, you can make 200,000 on this one position. Everything else would stop out. So I personally like a decent amount of width. I'd rather get at least 150, 200 width on a put debit spread if I could.
Okay.
There's a lot of ways to think about it. Another thing to look at is if you look at your, I forgot exactly where it is. There's a place to show like what happens if the market just goes nuts. I think you just click clap required on Tasty Trade and then you go to analysis tab. It's on this window here. Yeah, so you can do risk analysis on the cap rec button. I haven't set it up yet, but what you can do is have all your positions here, and then you can see what happens if volatility goes, 1 standard deviation, 2 standard deviations, and whatnot. So you fiddle around with that one to see what your max loss could be, depending on if the market drops a certain amount and if volatility goes up, and then you can try to hedge against that. The issue with hedges is there's no real perfect way to go about it because the more you're going to spend on hedges, the less overall you can make if the market doesn't drop. But if you don't hedge at all, and small moves down could obviously hurt you. So it's a fine balance between the two. I think the easiest way to go is be willing to spend part of your net lick every month on buying put debit spreads or puts.
Yep. Thank you.
No problem. I'll leave it over
So-
for Q&A right now. And I know Jerome Powell's talking right now, but I'll leave it up for questions for now.
So Lance, where is your latest like hash trade? Could you show us on the Discord?
I think it's under Safeguard and Strangle and Inner Circle. And then it's 180 DTE 101 heads right here. So if you look on the left side of the screen, the way I set these up, I'll just show you the trade first, and then I'll show you how I'd set it up. So I did a 300 width put debit spread here, bought the 4,800, sold the 4,500, and then I sold one of the 4050. This acts similar to a hedge, but it's not a true hedge because I have 2 sold puts against 1 bought put. So if the market drops really hard, this will actually lose. However, in most cases, you're going to be able to be okay because of that 100 width hedge. The way I set it up is I go to closest to 180 days out, say 170 days out. I find where the expected move is. It's that little blue dashed line. And then I'm going to buy the put right below it, make it a 300 width. So sell the 4,600. And then I look at what the debit is. The debit on this would be 18.5 or so. And then I'm going to look for the sold put that's pretty much the same cost as that debit. So here would be around a 4,200, and I would sell one of them. In this case, it's pretty much a break-even trade when you're starting it. I have a lot of protection in that 300 width, and that 4,200 is a very low delta. Okay? You can fiddle around with this even more if you want in different widths, where you actually put these on. You could go closer to in the money if you want possible profit there, maybe 5,200, 4,900. Then the credit of 33, you have to go a little closer to the money on the next sold put to pay for it. Or you can even do lower widths if you want. So there's a lot of ways around it. I was fiddling around quite a bit, and I think that gives me the best benefit. 300 width, it's a pretty large max profit there. And then I'm going to close those out. The very farthest out of the money sold put, I'm going to close out at 2 premium. I was fiddling around with maybe closing it a little earlier, but it's so far away that I think it's okay. And this is an older hedge that I did 47 days ago. The 4150 sold put already decayed quite a bit. I want to wait for this to be around 2 premium, and then I'm going to buy this back and roll the sold put up at whatever width of the cost of buying this back. So if this is a 2, I'm going to roll this up until I get a 2 credit on the roll. And at that point, I have a smaller put debit spread, but it's a pure hedge at that point because I have no other sold put below it. Okay.
Yep. And these line numbers, could you just show me? I couldn't find the spreadsheet.
So we go to ebook strategy guide. I'm going to start here, right here. You'll see, let's see, it's near the beginning of the year, 2024 spreadsheet right here. And then if it's a safeguard trade, you want to look for a safeguard on the bottom, and then just find the line number under the safeguard tab. And then that's how I group my positions. It's also easier to find them on Discord so you know which group I'm talking about.
Yep.
So this would be like line 60 heads, line 54 heads, and so on. All right, I'll leave it open for anyone else that's in for any general questions so far. Vincent, how's everything going so far? Are you overwhelmed yet, or are you good? A little bit?
Absolutely.
You're absolutely
It's
overwhelmed.
Absolutely overwhelmed. But it's starting, the more I listen, it's starting to make a bit more sense.
What
Certainly
general
on the
questions?
hedging.
What general questions do
What's
you have
that?
so far? Any general questions so far?
Not really. I think you kind of just answered it. When I'm looking at the futures and I'm looking at the put debit spreads like the safeguard, the 112, and then being in Canada and IBKR, I've been exploring those kinds of additional, like adding on additional puts to cover for buying power.
Yeah.
And then sort of freaking out about the downside
Yeah.
possibility. But as you start talking about the hedges, I think early on that'll make sense. And as you said early, just stick to the MES versus the
For now.
ES that I was
Yeah,
jumping
definitely
into.
stick. Yeah, definitely stick with MES when you're starting out because it won't necessarily hurt too much if it gets past the stop loss or anything like that.
Yeah.
At IBKR, you could do stop limit orders on futures. I'm not sure if you're aware of that, but it's the only brokers that offers it. So what I do personally is when I'm looking at my positions, I'll see what the P&L open is as a percentage. So if I look at P&L open percent, and I already know in a safeguard, if I'm at 200, negative 200%, so if it showed 200 in red here, I'm going to be stopping out of the trade, but I'll have to manually stop out of it. On IBKR, you can set it up where it's a stop limit order where it'll actually try to stop for you. So if you're really concerned about like a gap overnight or something really dramatic happens, you could possibly set those on. There's going to be some times where it's going to be a little over 2%, 200% because you just didn't get it in time. But
yeah,
I mean, if you'll see the market dropping, you probably would be aware of it. And all you really have to do is check once a day or so and see what your P&L opens are. And if anything's relatively close, you want to consider looking into it more.
That makes sense.
Like this oil 112 I did yesterday, it was near 60%, I think. But then oil shot up a lot, so it's up quite a bit today. I would close this out at negative 200 though. So even if you're at negative 60 or so, that's still not necessarily something to like watch every minute and make sure that you're closing it out right at the same time. But if we're near like 170, 180%, I'm definitely going to keep a closer eye on it. Yeah. All right, leaving it open for anyone for questions. Otherwise, we can look at put credit spread. I'm not sure who iPad Pro is, so if you're there, you could have any questions.
Lance, just this crude oil 112, that's
Yeah.
a bullish trade.
It is a bullish trade, yes. So when you're doing 112s on the put side, you want the market to stay where it is or go up in terms of having a smooth P&L. If the market drops to where your put debit spread is, though, that's where your max profit is. So if you look at this one, I bought a 72, sold a 70, and then sold 261s. The max profit is between the sold puts at 61 and the sold put of the put debit spread at 70. So best case scenario, it closes at like 69.9 or something at expiration. Because then at that point, this is at max profit, and this would have been worthless. However, if the market drops initially on a trade in the safeguard, you will show some initial P&L losses because the two sold puts will decay and be more of a loss than the gain of this put debit spread. So yeah, if you look at this one right here, I'm still at a negative P&L open from when I entered it because oil is a little lower than it was when I started it. So the 72.70 put debit spread is up about $200 because the market dropped a bit in oil. However, the sold puts are down a little more than that. It's down 340. So that's why it's showing a slight negative. As you stay in the trade longer and longer, the put debit spread helps out more. Put debit spreads usually need near expiration to make a lot of profit on them because there's still a lot of time decay left. So that's why it starts off being a bullish trade, and then it ends up being more of a bearish trade near expiration. I guess absolute ideal scenario is the market stays where it is or goes up. You close those naked puts at a really good profit. I usually look for around 90% profit on the naked put. So if I sold it at 0.55, I'm going to buy it back at 0.05 or so, get about $500 per contract. And then ideally the market drops after you close this. Because once you close this out, there's no more risk on the trade. We already made more than enough profit on the two nakeds to pay for the debit spread. And then if the market drops, the debit spread can pay off after.
Okay.
What's really good about these is as a campaign trade, as you'll see, I did these every 30 days or so. It smooths it out a bit. Like the one that's 48 days left, the put debit spread is going to start helping even more as we get closer to expiration. But then the other trades that are further out in time, if the market drops, these would get hurt a little bit more because of those naked puts, but this would be benefiting from it. So it kind of smooths off the path a bit by doing these as a campaign, doing them at a regular interval. And that's where I think the key is for safeguards in general.
Okay. So like I haven't done any crude oil trade. So which one would I pick? Just the last one?
I guess you can start with this one. It's 138 days out, so it's a bit of time. You'll get a pretty similar premium to what I got. I'm only up $70 on it. So you'll get a little less than me, but it's still a good enough trade. You're making almost $1,000 on the naked puts. And then the debit spread's about, let's see, 300. Yeah, it's around 300 or so. So you'll still start the trade at around $600 or $700 in credit where you're starting. I
Okay.
think it's still fine to take it, and it's still really far out. Real quick, to figure out how much buying power you need, you could either just enter the trade, or if you're already in the trade like I am, just do closed position and then see how much buying power you'd get back. So I'd get back about $3,000 in buying power. It should cost about the same if you're starting the trade.
Yeah,
And then
makes
you want to keep a few thousand extra. I'd do about $6,000 total for one of the oil safeguards. Oracle PCS, yeah. Let me look at Oracle real quick. I just put in the order and I was actually waiting on it for about 30 minutes before it filled. I can't spell. Yeah, dropped a little from when I entered it. It's still back up. You could try to fill it for another dollar or two more if you want to. Or just stay in it. We're at 139. Still pretty far away from where my strike was. Forgot where I was exactly. 130. You're still relatively safe on it. You could maybe wait. All right, let me enter in. Let me first look at SPX. It didn't move dramatically. And then we'll enter in the put credit spread. Yeah, it's still back up. So this is when FOMC minutes happens. Jerome Powell's probably saying certain things that the market likes. So it's staying where it is. Actually, this is when the Fed minutes said that the rates are unchanged. It didn't really hurt it. They were up pretty big. All right, so let's get a look at Microsoft for the credit spread. Let me look at the chart first. So it dropped a bit overnight because they only made what, $29 billion? Poor Microsoft. How are they going to survive? All right. They recovered a bit. I mean, you don't really see much in the last day. Get rid of the lines real quick. All right, so if you look at Microsoft, we bounced off 405 pretty aggressively. We bounced again. There were two touches. It dropped a bit, then recovered the same day. So we dropped a bit around 393. That's probably not going to pay enough. Ideally, I could find around 390 to sell the put at. I don't even remember what I put in the morning, so we'll just do it here. Microsoft dividend on August 15th. All right, no one want to change anything. So we could go below that 390. 392, it bounced twice. Looking at the EMAs, we're really close to the yellow one, which is the 9, I think. So we're close to the 9 EMA anyway. I was thinking it was overblown a bit. However, the market recovered a bit on it just because everything's up today. 390 is still good. We could go even lower. We'll probably go 385 or 380 even. Let's look at 385, 380. It pays about $60, which sounds fine. 380, 375 pays $45 to $50. This is also okay. If you want to be a little bit safer about it, you can sell the 385 to 375. I think 385, 380 is still fine as well. Go for a little bit more premium here. Let's see if I get filled around 65, and then I'll go down. I usually start a little bit higher than where the mid is. You never know, maybe you get lucky and you get filled. And then I'll slowly go down $1 until I get filled. Yeah, 62 or so might work. Yep. So I got filled at $62. Let me just put this in the Discord so everyone else can see it. You can see my inner workings. I highlight, I paste, change the info. I don't normally do this, by the way, because I'm usually on my phone at work, and then I'll have to type this out on my phone. All right, 385, 380.16 delta. I got 62. So I put a lower price here for getting at least, let's say 55 or more. That's 62. I don't personally put the stop loss in, but if you're interested in that, I would go around 1.9 or so in the stop. And now the alert price, it was where that bounce happened at the 390. You see the multiple bounces here, 392 or so. I'm going to make that the alert price. Because if it gets there, I'll go a little lower, 391. If it touches there, then you have to watch out for it. It might recover from there, might not. We're at 419.26. Delta was 0.16. I'll just say recovered from that earnings. All right, so if any of you guys are watching, you could try to get into this trade as well. Just gonna add it here too. Alert price was 391. I forgot how to do an alert price on Tasty. I could do it on my phone. I forgot how to do it on brokerage, like the computer. I'm not sure if anyone knows. All right, I'll leave it up for any other questions at this point.
So Lance, I'm still in your old Microsoft PCS.
You're in the original one?
Yeah, I just was hoping it would go up.
What's the premium at right now? If you closed it? I closed that out about a week ago. I don't even remember what strikes it was.
It's 2.8 right now.
Yeah. Okay.
So I was thinking like I could do
425. Yeah, 425, 420 is tough because we're still below the spot put.
Yeah. So
I'll just close it out, to be honest. I think it's too risky. Because if you wait the next 16 days and it doesn't recover, you lost the $500 minus your credit.
Okay. Right now I just lose like half of the max loss, right?
Yeah, if you buy it back for around 200 or so now, you'd be down about 200 minus the 47 or so. You'd be down about $150 instead of possibly down $450. It could recover, but it's against you right now. I mean, if the general market goes up, it could work, but I think it's too risky.
Okay.
I'm a bit hesitant to stay into earnings on those stock spreads. Sometimes I'll do it if it's still really far away. But then we have cases like Microsoft that just dropped like a ton and still recovered a bit. It was still quite a bit below there before earnings already. So that's why I think if it hits your alert price, if you want to be safe about things, just get out. Yeah, because you had an opportunity here to close it out before when we got below that alert price.
Oh, okay. I tried rolling it, but I was not for a credit. It was not getting filled. I
Yeah,
tried like several, like 1 week, 2 week, 3 week, so on.
right. If it drops a lot and you get below the bot put, rolling it is going to be hard. You might not get much credit at all. The best time to roll is when you're still out of the money on your short and close to expiration if you could, because then you at least have most of the time decay that you already got from it. I would just close it, to be honest. You could roll it and do all that and wait, but I don't think it's really worth it because when you're rolling for very little credit or break even, you're just waiting more time for it to recover just to maybe not lose in the end. I'd rather just think about it as a probability exercise, and the probabilities didn't work our side in that one trade. You just get out and then just move on to another one. But that's just me.
Okay. Yep. Thank you.
iPad Pro or Vincent, any other general questions? Vincent, have you been taking any of those quick credit spreads that I do?
Oh yeah,
Okay.
since I met you, I'm
Yeah,
just trying to do the one right now.
those are very buying power efficient. You only need $500 minus the credit. So you only need
Yeah.
about $450 for one. We usually are open in about 8 to 12. It's hard to say. Sometimes we're in more positions because we're waiting for them to close out. Other times we close them out quicker. So 10 is a reasonable number to work with. So
Okay.
an easy way to figure out the math on this is figure out how much of your account you're willing to do for just the put credit spreads, and
Yeah,
then divide by 10 and divide by 500. That'll tell you how many positions to do. So for example,
Okay.
if you have $10,000 and you want to do these, if you divide by 10, it's at $1,000 per trade, and then divide by 500. You can do 2 contracts at that point. So it's good to do like a close round number, and then you can do the same amount of contracts for each position. It's just a good way to think about it, I think. Any other
The reason
questions?
that
Go ahead,
I was
Vincent.
going to let the other guys go first. Mine's just again, I'm still in that really simple thinking of when you've got the number of put debit spread, when you've done your campaign, so then you have several naked puts out there. To me, that scene again, so they're so far out. The delta 0.05, so they're so far out. But when you still have that many, I guess it's only a black swan event that you're going to come and get hit with everything. But that's, to me, that seems like it's kind of so there's a lot of risk associated in that kind of setting versus the probability of the math of not happening. Like obviously, if that happens, there's bigger things to deal with, but that could sort of decimate your account.
Yeah, you're definitely right. If the market took a really big drop, the more likely scenario is you get a decent correction, maybe up to 5 to 10% in a month or two, and your buying power could be challenged a little bit. Where if you're getting closer to the money, then your buying power will be going up. So that means, or buying power that you're using will go up, which means that you could be tough to add in more trades and whatnot. So that still doesn't mean that it's going to lose though. Like if you're so far out of the money, we're looking 20, 22% out of money in some of these. And sure, there's a lot of time, 120 days, 4 months, they could easily drop that much. But if you see like a 5 to 10% correction, you still might be in the trade. You still may not even hit your stop loss on it. And then the more main issue is wearing like a buying power. On a very dramatic move, you'll want to look at the different hedge type trades that we do. There's a black swan hedge. If you go to ebook strategy guide, it says hedging strategies. So I put a few different ones that I've found. Where is it? There we go. So hedging strategies, more hedging strategies. This one's more of I found from many different places. The bottom one on the second page is the Black Swan hedge. I
Yeah,
don't know what happened to my plus minus here. Black Swan hedge is where you buy really, really far out of the money puts, and then you essentially buy more puts a little below it. So you have a ratio hedge essentially,
yeah.
a ratio spread where you have more bought than sold.
And
And
do
this,
you, is that something you employ or do you not?
I haven't done it yet. I'm still debating if it's even worth it. The way that it's set up, you're going to be selling 3 puts for $3. So let me share my screen here. I've never done it yet. It might be worth it, but there's also a bit of risk if you time it wrong. Or if you're okay starting it off with a decent debit just to have it started, then you could do the others for pretty much no debit. So you go on ES, you're going to look around 120 days to start, and you're going to buy the puts that are around 3 premium. So it's really, really far away. 0.1 delta, like nothing. But this is good for a huge drop. I mean, if it drops 2,500 points, you sell 3 of these first.
Mhm.
So you sell 3 of these, and then you essentially put in an order 50 points away from it. I can't even do 50 points away because it doesn't exist right now. But when you're around 70 to 80 days out, the 3,050 strike will come up. And you're going to put a order to buy 5 of them. When you put a strike below, it's at 140. Yeah. You buy 5 for, I think it was a little bit less.
Okay.
You buy 5 puts at 1.4, but it's not at 1.4 when you start. So that's the issue. So you're starting off the trade with 3 sold puts and then hoping the market doesn't drop a lot. In about a few weeks, I think, you could buy the 5 puts for 1.4. So if you do the math, it's about a break even at that point.
Yeah.
You're paying 9. You're doing 1.4 times 5. You're getting back 7. But then you buy back the 3 that you sold at around 0.4, I think it was. Or 0.2. So you buy the 3 back at 0.2 to pretty much make it up. It's a bit of work and it'll probably never actually do anything. But when the big drop happens, it could help. It's hard to say.
Yeah.
I personally rather do stuff that has a little better chance of actually profiting. That's why I'm doing that 111 300 with, because the deltas are a lot higher than the 0.01 delta. Those are never going to profit unless there's a huge black swan drop.
And is there any kind of concern with upcoming election to play into it, like the volatility around the election, or it's not really that?
Hard to say. If you go to VixCentral.com, I'll leave it on the chat. You can see where current volatility is and where the future volatility is from the VXX. Where we went down a bit today, this green line is the current volatility of the current VIX. And then the blue line are the future date VIX. So if you look near the election, they're assuming that's going to be around 17 or so for the VIX, and right now we're 15. So it's looking at a little bit of a jump for the election. However, for the September, we're in contango, meaning the current VIX is lower than where the expected VIX will be. If this green line is below the blue line, that happens about 80% of the time, and that means that we're in pretty normal situations. If the VIX shoots up, and let's say the VIX goes up to 19, this curve won't necessarily change that much, even though the current VIX went up, and there'll be backwardation. at that point, it's probably going to curve up in the blue line eventually. Although not always. I can't say it's always going to happen. So anyway, right now, it's looking like there might be a little bit more volatility in the election, but it's not dramatic. We're looking at 1.5 or so higher. Obviously, things could change, but we don't necessarily know that yet.
And it's not party, again, I'm being ignorant here. It's not really party specific. It's really just election kind of behavior that the usual, like a Jerome Powell speech as he taps the mic and the market goes down.
As he breathes or blinks a certain way, he has so much power. Like, not only what he says, it's like how he says it. It's like the tone of voice changes. It's crazy.
Yeah.
Based on certain election stuff, I know Nate Silver has been doing a lot of research on Kamala Harris to see. And right now, the initial polls are looking like this could be a very close election, at least right now. The swing states that are like Wisconsin, Michigan, Pennsylvania, those are very close right now in the initial polls. Obviously, that could change, but it's hard to know what's going to happen. I think in the initial poll, it's saying Kamala Harris has around a 35% chance of winning already. It's not that low, and that could easily change. So yeah, I don't know. Depends on what happens right before the election. If there's a bit of uncertainty of who's going to be the next president, like a few days before, the volatility will fall. Because, a whole bunch of economic things could happen depending on who the president is.
Yeah. Okay.
It might be a good idea in general to use a less of your buying power right before the election in general. And I'm guessing it might be a relatively close one. So because of that, you might want to just keep a little bit more cash on the sidelines just in case, or buy a hedge. I bought a small election hedge put debit spread. I think it was like 150 with or something. Yeah, I bought a 4750, 4600 put debit spread. And that ends right after the election, like 107 days.
I figured just now that I'm starting my as I build the campaign starting now, and then just as I'm going to be over that time period.
Right. We're also
That's my first one.
You're also doing MES first, so because of that, you're staying low in your BP anyway. It's a good, almost semi-practice mode. Like, if the worst cases happen and you have to stop out, at least you'll be aware if it's MES, it's not going to really hurt you too much. But if you're doing them with a lot of ES or SPX and whatnot, that would really hurt, and then you could learn in a more negative way. It's education. Doing it with small MESs probably makes sense.
Yeah.
Because we're timing them out now. It's 120 days. It's after the election. Some members in the group were purposely scaling down the last few trades I did than what they normally did, just based on the election happening. So, but I wouldn't worry about it if I was you. Just do the MES for now and see how they work. And then, when you're ready, you can start scaling up a little bit more. Do a few more MESs or do MES.
Okay.
All right, I'll be around for another 5-10 more minutes if you have any other questions. Market is just shooting up. $55.41. Okay.
That's the IWM.
This is like some basic technical analysis on the markets. SPX is now, I'll do the dailies. On the daily 3-month, we're now above the 8, 21, and 50 EMAs. But that's the hour though. Hold on. Gotta go to the dailies. We're now above the 9 and 21 EMAs. Oh, we're above everything. If you see, last night we closed right at the 50 EMA, the purple line. And then with this up move, we're actually above all the EMAs. This black line's the AVWAP having to do a certain time frame. And I set it at the low from August. So around 53.70 is the quote unquote fair value price from people that bought in at the low. And we're still good there. And then if I look at the high, let me go to the high up here. Oh, sorry. Drag it. My mouse is having trouble double clicking. I don't know why. All right. So it's pretty recent data here, but the high from July 16th, we're slightly above that now. Pretty bullish signs in general. Were you looking at IWM, you said?
Yeah. Small
Do you
cap.
know what happened today? Why did it go up today?
I can only guess. It might be that leader of Hamas was assassinated. The market went up a decent amount last night before. And then I'm guessing the market was thinking that the interest rates would stay where it was, and it did. It's hard to say. There's so many factors involved. This double clicking is ridiculous. Okay.
Oh,
IWM is, yeah, IWM is doing well.
So that Tom Lee I was going on about, the fund strats, equity strategists, they had really confirmed that IWM small mid cap was going to go up based on just that confirmation that there should be a rate cut coming. They were a bit surprised at the rotation out of tech as much, but they said that should have settled out this week too.
Yeah.
Kind of a return based on the fundamentals. So it seems to be playing out with
For now.
For now,
This
yeah,
is my-
until tomorrow.
Yeah. This is my largest holding. It's small cap value ETF, SLYV. It just shot up since July. My buy and hold went up a lot because of this. It was at 77 to 89 already in a month. Yeah, it might. There's a good chance the market cuts 0.25 in September, and they're expecting another cut around December, I think. Yeah, market's looking good. I was just looking at the EMAs for IWM and SPY. We're still okay. The 50 EMA and IWM is at 210, so that's a big drop, but we're nowhere near it. We're pretty bullish based on the EMAs. Like all the EMAs are curving upwards on IWM. So I think you just keep going bullish. And SPX, you can see the slope of these EMAs are more flat. So there's still some indecision here. But it's a good sign they're above that 50 EMA in purple. Doesn't mean it can't get there again. But yeah, I think so far right now in the short term, we're pretty good. Any other questions or thoughts?
That's great.
All right, I guess we'll close it here. If you have any questions, let me know in the Discord, and see you guys over there or online or wherever we are, all right?
Thank
Where we
you.
going, guys?
Thank you. Bye.
No problem. Have a good rest of the day.